Imagine you check your investment portfolio, right? And you see a massive tech giant, like a total household name in the corporate world, dropping from the mid-280s all the way down to roughly $174 a share.
Ouch. Yeah, that is a brutal slide.
Exactly. I mean, you would probably just assume the underlying business is falling apart. But what if I told you that that exact same company just generated over $14 billion in pure free cash flow?
It sounds totally contradictory.
Right. But that is the exact, honestly, incredibly counterintuitive scenario playing out with Salesforce right now.
And it creates this really fascinating tension for anyone watching the market. I mean, you have a stock price that is heavily pricing in this massive loss of growth.
Oh, absolutely.
But then you look under the hood, and the underlying business model, like the actual cash generation, is stronger than it has ever been in the company's entire history.
Which means we obviously have a puzzle to solve here today.
Uh-huh.
We're opening up a deep value intelligence report from May 17th, 2026, specifically looking at Salesforce, ticker symbol CRM.
Yep, the big one.
And our mission today is to look at this company strictly through the unemotional lenses of, legendary value investors. People like Warren Buffett, Peter Lynch, and Philip Fisher.
We really want to figure out if, at $174 a share, Salesforce just a classic value trap, or if the market is basically handing us a massive opportunity.
Exactly. But hey, real quick, if you want to track the total market temperature while we do this, I highly recommend you search for and download the iOS app Buffett Indicator from the Apple App Store.
Oh yeah, highly recommend that one.
And to access more advanced researches, applications, and our latest published personal intelligent multi-agent deep value intelligence, welcome to explore and join the deepvalues.ai community.
Awesome.
Okay, so let's set the stage here. You said we need to rethink our assumptions about Salesforce. What exactly do you mean by that?
Well, just ask yourself this. When you hear the name Salesforce, do you picture a wild, high-flying tech company that's obsessed with growth at all costs? I mean, historically, yeah, definitely.
Right. Or do you picture a predictable, dividend-paying stalwart? Because right now, Salesforce is a company caught right in the middle of a profound structural identity shift.
So they're basically transitioning from the former to the latter.
Exactly. They're fundamentally changing.
Which makes sense because, well, look at their financial footprint for the first quarter of fiscal 2027. The revenue came in at $11.13 billion.
Yep.
And that is up 13% year over year, which, is decent, but it is certainly not the explosive hyper-growth they were known for back in the day.
No, not at all. The top-line revenue growth is definitely maturing. But the real story, the thing investors really need to pay attention to, is what is happening to their profit margins.
Okay, let's unpack this.
Yeah.
Because historically, they ran on really thin margins. Right?
Oh, incredibly thin. I mean, they were notorious for taking every single spare dime and plowing it right back into aggressive sales, marketing, and just these massive, flashy acquisitions.
Just to capture market share. Like a wild partying teenager.
Yeah, that is a perfect analogy, but that spending faucet has clearly been turned off. I mean, looking at the report, their GAAP operating margin jumped to 21.1%.
Wow.
And their non-GAAP margin reached nearly 35%, which is just staggering.
Okay, wait, just so we don't get totally lost in the accounting jargon here, break down the difference between those two for us.
Sure, yeah. So GAAP refers to these strict standard accounting rules every public company has to follow.
Right.
And that includes a lot of non-cash expenses, like stock-based compensation for their employees.
Got it.
Whereas non-GAAP is essentially management coming out and saying, hey, if you strip out those one-time or non-cash costs, here's the actual operating profitability of our core business.
Okay, so hitting almost 35% on that non-GAAP margin, that must have crushed analyst estimates.
Oh, it absolutely crushed Wall Street's expectations. It basically proves that their core software business is an absolute cash printing machine when they actually sit down and try to be efficient.
So it wasn't that they suddenly figured out how to sell twice as much software. It's that they completely restructured how they operate from the inside out. Like that teenager finally getting a corporate job and becoming obsessed with saving.
Precisely. And if we, connect this to the bigger picture, this shift wasn't just some spontaneous enlightenment by management.
It never really is it?
No, not usually. Back in late 2022 and early 2023, Salesforce faced massive pressure from a group of activist investors.
Oh, right. I remember that.
Yeah, these activists looked at the bloated cost structure, the endless string of expensive acquisitions, and they basically forced a pivot. They demanded operating leverage.
And the CEO, Mark Benioff, He actually listened to them. I mean, he dismantled the company's M&A committee entirely.
Which is huge for a company that loved buying things.
Exactly. And he cut the headcount by 10%, consolidated their massive real estate footprint, and honestly, the financial result of that discipline is wild.
It really is.
I mean, their free cash flow margin is now sitting at almost 35%.
And here is where the story shifts into classic value investing territory. I mean, what do you do when you generate $14.4 billion in free cash flow in a single year?
Buy another startup. At least that's what they would have done in the old days.
Exactly. They would have just bought another tech toy. But instead, in fiscal 2026, they returned 99% of their annual free cash flow directly to stockholders.
Wait, 99%.
99%.
That completely rewrites the narrative for them.
It really does. But they actually went even further than that. In the first quarter of fiscal 27, they executed a historic $25 billion accelerated share repurchase program.
But okay, here's the part that really made me scratch my head when I read the report.
Yeah.
They funded that massive buyback entirely by taking on $25 billion in debt.
Yeah, they did.
Why on earth would a company that is generating so much cash borrow money just to buy its own stock?
Well, it is a very aggressive capital allocation maneuver, for sure. But it sends a massive signal.
What kind of signal?
By taking on debt to buy back stock instantly, management is essentially screaming to the market, we believe our stock is so deeply undervalued right now that it is mathematically smarter for us to borrow money at current interest rates to buy it.
Oh, rather than waiting to just use their cash flow over the next few years.
Exactly. It artificially shrinks the number of shares on the market, which immediately boosts earnings per share for the remaining investors.
Okay, I see. So they've engineered this massive profitability, and they are aggressively rewarding shareholders. But, generating all this cash today is only half the battle.
Right, you have to protect it.
Exactly. To keep doing it, they need a product so sticky that customers literally can't leave. So what does their economic moat actually look like?
Well, it is incredibly deep. I mean, look at their gross margin. It sits at an astonishing 77.7%.
Wow.
But the real moat is in their customer base. They act as the operational database of record for 90% of the Fortune 500.
90%. And because of that deep integration, the report notes their customer attrition rate is a tiny 8%.
Which is practically nothing in enterprise software.
Right, meaning 92% of their clients stick around every single year.
That is the literal definition of high switching costs.
Yeah.
I mean, if you are a multinational corporation and you have built your entire sales, marketing, and customer service workflow on top of Salesforce.
It's basically your central nervous system.
Exactly. Ripping that infrastructure out and moving to a competitor is agonizingly painful, expensive, and honestly, super risky.
Yeah, you don't just swap out a nervous system on a weekend.
You really don't. But, a sticky legacy product doesn't excite the market on its own. The market always wants to see the catalyst for future growth.
Which brings us to the AI pivot.
Yes. For Salesforce, that entire future hinges on their massive pivot toward artificial intelligence, specifically their Agentforce in Data 360 platforms.
And the traction here is just undeniable. I mean, these AI platforms just pass $3.4 billion in annual recurring revenue.
It's massive.
The Agentforce system alone grew 205% year over year. But beyond the sheer growth numbers, the thing that really caught my attention was how they are changing the way they actually charge for this software.
Oh, this is fascinating.
I really think this might be one of the biggest shifts in the tech industry right now.
What's fascinating here is that it is a fundamental paradigm shift. I mean, for decades, the entire enterprise software industry was built on a seat-based subscription model.
Right, so if you have 1,000 customer service reps using the software, you pay Salesforce for 1,000 licenses or seats every single month.
Exactly. You are basically renting digital desk space for your human employees.
Right.
But with Agentforce, they are abandoning that seat model for something called consumption-based pricing. They are charging $2 per agentic work unit, or AWU.
$2 per task, essentially.
Exactly. They are charging a flat fee of $2 for every specific task that an autonomous AI agent successfully completes for the client.
Wait, okay, let's pause and do the math on this because I really need to understand the logic here.
Let's do it.
If I am a company and I'm paying an AI $2 to resolve a customer's lost password ticket or analyze a sales lead, I don't need a human employee to do that anymore, right?
Theoretically, no.
And if I fire the human, I'm going to cancel their Salesforce seat license. So doesn't Salesforce inherently lose money on that trade?
Yeah.
Are they basically cannibalizing their own core subscription business?
That raises a really critical point, and it is the exact tension at the heart of their new strategy. Salesforce is attempting a very delicate balancing act here.
Oh, so?
They are shifting from capturing the value of the worker to capturing the value of the work itself.
Okay, I see.
If an AI agent can resolve an issue for $2, that is exponentially cheaper for the enterprise than paying a human's full-time salary and benefits.
Well, for sure.
So Salesforce is making a massive bet that the sheer volume of these $2 tasks will just explode, and that the revenue from millions of automated micro tasks will more than offset the revenue lost from canceled seat licenses.
That is a huge gamble, and honestly, the irony here is almost too rich.
Oh, I know what you're going to say.
The report points out that Mark Benioff actually eliminated 4,000 customer service roles internally at Salesforce after deploying these autonomous agents.
Yep.
And this was after earlier claims that AI wouldn't replace human workers. I mean, they're literally proving the cannibalization concept on their own workforce.
Well, it certainly proves the efficacy of their AI. I mean, if it works for Salesforce internally, it will work for their clients.
Fair point.
But it absolutely validates the market's fear that seat-based revenues could permanently shrink across the entire software industry.
Which perfectly explains the friction we are seeing in the stock price. Because, if the cash flow is this incredible and the AI revenue is tripling, why did the artificial intelligence analysis system in this deep value report rate Salesforce as just a watch instead of a full-blown advocate or BIY?
That is the million-dollar question. And it comes down to a fundamental structural limitation with AI right now, which we can call the 74% problem.
The 74% problem. Tell me more.
So, for an autonomous AI agent to be truly useful enough to actually justify that $2 per task fee, it requires deep, comprehensive data about the business it is serving. It needs total context.
That makes sense.
But currently, only about 26% of an enterprise customer's total data actually resides inside the Salesforce ecosystem.
Wow. Okay, so the other 74% is trapped out there in what? Legacy systems,
Yeah.
old mainframes, or entirely different software platforms.
Precisely. Think of it like hiring the world's smartest business consultant for $2 a minute, but locking them in a windowless room where they are only allowed to read a quarter of your company's files.
Oh, they would be useless.
They might be brilliant, but they are working blind. So the return on investment for the customer drops significantly. The AI might give incomplete answers or simply fail to resolve complex issues.
And remember the pricing model.
Yeah.
If the AI fails to complete the task, the customer does not pay the consumption fee.
Exactly.
That makes perfect sense. I mean, put yourself in the shoes of a corporate buyer. What stands out to you? Would you authorize paying $2 a task for an AI system if it can only see 25% of your company's data?
Probably not.
Definitely not. You would demand to be connected to everything before you ever open the checkbook.
And connecting all that siloed data is incredibly difficult. Now, Salesforce is trying to solve this with integration tools like MuleSoft and Data 360, but it is a massive, massive bottleneck.
And you have to add the current macroeconomic environment to that, right? I mean, interest rates are higher, and customers are heavily scrutinizing every single dollar in their IP budgets.
Oh, absolutely. Not to mention, competitors aren't just sitting still. Microsoft, Oracle, SAP, they are aggressively embedding native and often much cheaper AI tools directly into their own platforms.
They see blood in the water.
They really do. And they are coming straight for Salesforce's 20.7% market share.
Plus, there's the internal side. There is a very real operational friction happening internally at Salesforce, isn't there?
Yes, there is. Imagine their massive global sales force. For 20 years, these reps have been heavily incentivized and compensated to sell traditional multi-year seat-based contracts.
Right. Predictable recurring revenue.
Exactly. And now management is demanding they pivot and sell consumption-based AI.
Oh, man. That is a tough transition. You are basically asking a salesperson to give up a massive guaranteed commission on a 3-year contract in exchange for a trickle of $2 transaction fees.
Changing the behavior of a sales force that large takes a lot of time, and it inevitably creates a temporary lag in cash flow conversion.
So all of this creates uncertainty. The market is looking at this landscape and feeling deeply skeptical.
Very skeptical. Investors are terrified that instead of being a massive new revenue stream, AI might actually just commoditize software.
Meaning?
Well, If AI tools eventually become so smart that they can easily translate data and move workflows seamlessly between different platforms, maybe those high switching costs that form Salesforce's economic moat start to erode over time.
Ah, I see. So the market refuses to give Salesforce a premium valuation because the path to AI monetization is murky and the core seat-based growth is naturally slowing down.
That's exactly it.
Here's where it gets really interesting, though. Let's look at the actual valuation scorecard through the eyes of Warren Buffett to see what this all means for the stock price. We have established the business quality and the risks.
Right.
Does a stock price of $174 actually offer a true margin of safety?
Well, the report starts by looking at the Piotrowski F-score. This is a 9-point system used by value investors to measure the fundamental financial trend of a company.
How do they score?
Salesforce scores a solid 6 out of 9.
Okay, not bad.
It passes with flying colors on positive net income, strong operating cash flow, and gross margin improvements. Where it fails is on decreasing debt.
Ah, and that is entirely because, as we discussed, they took out that massive $25 billion loan to buy back their own stock.
Exactly. It dinged their score, but for a strategic reason.
Okay, so the underlying operations are very healthy.
Right.
But let's talk about the intrinsic value map, because the numbers here are kind of all over the place.
They really are.
Using the Buffett method, which focuses on owner earnings, the conservative value of the stock is calculated at just $86.
Which is way below current levels.
Right. But then the average value is $421, and the optimistic value is over $1,000. Just for clarity, what exactly are owner earnings, and why is there such a massive gap in these valuations?
So, owner earnings is a concept Warren Buffett popularized. It is essentially a way of cutting through the accounting noise.
Make it simple for us.
Basically, you take the reported net income, add back depreciation and amortization, and subtract the capital expenditures required to maintain the business.
Okay.
It tells you the actual hard cash a business generates that an owner could safely pocket without hurting the company's competitive position.
Got it. It's the true cash-generating power of the business. But why does that calculation give us a value of $86 on the low end and over $1,000 on the high end?
The variance all comes down to growth assumptions, that average case of $421. It assumes that Salesforce can keep compounding its owner earnings at its historical growth rate for the next decade.
Oh, but we already know that isn't happening. Management themselves are only guiding for about 11% revenue growth this year. The high growth days are behind them.
Exactly, so you have to heavily discount those historical averages. Meanwhile, the report also uses a standard free cash flow method, which values the stock somewhere between $349 and $500.
But again, that relies on growth.
It does. If we look at reality, at $174, the stock is basically fairly valued if you assume the company just stands still and matures into its current cash flow profile.
Ah, I see. And this is why the report categorizes Salesforce under Peter Lynch's framework not as a fast grower, but as a stalwart.
Right. A stalwart is a high-quality, highly profitable, cash-generative machine that remains strategically relevant.
But it is simply too big and growing too slowly to deliver those explosive 10-bagger returns from its current level, unless something radically changes.
Spot on. So a true margin of safety only exists here if you fundamentally believe that these agentic work units, this entire pivot to AI consumption, will create a real sustained reacceleration in their top-line revenue.
If it just stabilizes the business and replaces lost seat licenses, you are basically paying a fair price for a great business, but you aren't getting a screaming bargain.
Which perfectly explains why the final verdict from the intelligence report is watch. It is a phenomenal business protected by a real economic moat.
But the technological uncertainty around how AI will ultimately be monetized.
Combined with the slowing core growth, it prevents it from being a classic table-pounding value play right now.
It really leaves you with a profound question to mull over about the future of enterprise software and, honestly, the future of work itself.
Oh, for sure.
If the entire software industry transitions fully from renting digital desk space for humans to renting digital workers by the task, who are the ultimate winners going to be?
It's a huge shift.
Will the winners be the companies that build the smartest, sleekest AI software interfaces? Or will it simply be the companies that have successfully hoarded the largest amount of interconnected data?
Because as we saw today, an AI agent is only as smart as the data it is allowed to see.
Exactly. That is a massive paradigm shift to watch as this space evolves. Now, to wrap up our deep dive today, we must cover the necessary legal text regarding the intelligence report we just analyzed.
Always important to read the fine print.
Right. Disclaimer. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations.
Hmm.
All contents from this channel is for information and research purposes only and does not constitute investment advice.
Conduct your own due diligence before making investment decisions.
Exactly. And if you'd like to access wider topics including life and investing philosophy, please subscribe to our sister channel, Deep Values. Don't forget to like this video. Much appreciated.
We really do appreciate it.
Now for the critical disclaimer. This report is generated entirely by an autonomous artificial intelligence system using large language models and automated data retrieval tools. It is provided solely for informational and educational purposes and does not constitute financial advice, investment advice, tax advice, legal advice, trading advice, a recommendation, an offer, or a solicitation to buy or sell any security or financial instrument.
Keep going.
No fiduciary relationship, advisory relationship, or duty of care is created between Deep Value Intelligence, its operators, affiliates, or any user of this report.
Yep.
AI limitations and accuracy. AI-generated content may contain inaccuracies, outdated information, or outputs that appear plausible but are factually incorrect.
They call this hallucinations.
DVI makes no representations, warranties, or guarantees, express or implied, as to the accuracy, reliability, completeness, or timeliness of the information, analyses, opinions, scores, stance labels, or valuations contained herein.
Basically, double-check the AI.
All data is sourced from third-party providers, including but not limited to Yahoo Finance, Simfin, FinHub, Reddit, and Google News, and is presented without independent verification by human analyst. Data may be delayed, incomplete, or subject to retroactive correction by the originating provider. No guarantee of results. Past performance of any security discussed in this report is not indicative of future results.
Standard market warning there.
Forward-looking statements, intrinsic value estimates, discounted cash flow projections, and any target prices are inherently speculative and subject to significant uncertainty.
Right.
Investing in equities, bonds, or any financial instrument involves substantial risk, including the possible loss of the entire invested principal.
Always know your risk tolerance.
The advocate, watch, or avoid stance labels are AI-generated classifications and must not be interpreted as personal investment recommendation.
Exactly.
Independent due diligence required. You must conduct your own independent research and analysis and consult with a qualified, licensed financial advisor, tax professional, or legal counsel before making any investment decisions.
Very important.
DVI is not a registered investment advisor, broker-dealer, financial planner, tax advisor, or legal professional under the laws of any jurisdiction. Limitation of liability. To the fullest extent permitted by applicable law, DVI, its operators, developers, affiliates, data providers, and technology partners shall not be liable for any direct, indirect, incidental, consequential, special, or exemplary damages.
Including but not limited to loss of profits, goodwill, data, or investment capital.
Exactly. Arising from or related to the use of or reliance upon this report, even if advised of the possibility of such damages. This limitation applies regardless of the legal theory.
Makes sense.
No endorsement.
Right.
The mention of any company, security, or financial product in this report does not constitute an endorsement by DVI.
Right.
DVI and its operators may or may not hold positions in the securities discussed.
Got it.
Jurisdictional notice. This report is not directed at residents of any jurisdiction where such distribution would be contrary to local law or regulation.
Users are solely responsible for ensuring compliance with all applicable local, state, national, and international laws and regulations.
Intellectual property. Copyright Deep Values AI. All rights reserved. This report may not be reproduced, redistributed, or transmitted without prior written consent.
Yep.
By accessing this report, you acknowledge and agree to all terms stated in this disclaimer.
Copyright.
Deep Values AI.
And we're out.